Hi everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host Niklas and next to me is my friend and colleague Eddie Palmgren. How are you today?
I'm thrilled. Today we have the great pleasure and honor of speaking to the legendary Richard Lawrence, one of the best investors in Asian equities over the last 3 decades. And Richard founded Overlook Investments in Hong Kong in 1991 and has since then delivered a very impressive CAGR of 14.3% per year, annually beating the market with about 6.5 percentage points. And the fund now has about $6.5 billion in assets, and this is despite returning $2 billion to investors in the last 3.5 years.
And which book will we talk about today?
Yeah, so due to, actually thanks to the pandemic, Richard got the time to write a book where he describes the Overlook model and also celebrates the 30-year anniversary for the fund. And this is about the strategy that has worked so well for his firm. And the book is called The Model, and it was published in February 2022 by Harriman House.
And why have we chosen this title?
Yeah, I see 3 reasons. First of all, we are truly impressed by Overlook's processes and the results. And we are extremely thankful for our friends in Singapore and Shanghai who have helped us to get in touch with Richard and even sent us copies of his book to Sweden. And secondly, in the podcast, we always base our conversations on a book. And in the end, it usually leads to a discussion about the investment style of that specific investor. So I think it's great in this case that the entire purpose of Richard's book is to explain the successful investment philosophy and the business practices of the Overlook Fund. And I really hope that our conversation today can be of high value for both fund managers and all other investors. And the third reason for choosing this book is to gain new perspectives from other parts of the world. And that is something we actively try to do because so far most of the authors and investors we have had on the podcast, they are operating in the US or Europe, and many of the books that we are looking at, they are focused on those areas. So the model, with its really excellent mix of real-time reports and also investment strategy from decades of experience in Asia, it really offers a perfect opportunity to broaden our views. And how does this book relate to Redeye's quality rating?
So the book covers the story of being an early investor in a region undergoing dramatic changes with plenty of lessons about, for example, corporate governance. The quality rating at Redeye consists of more than 100 questions in the 3 main categories: people, business and financials. And I think really about corporate governance, that's an important part of the people section. And also I think this whole way of thinking and rating businesses is quite similar to Overlook's philosophy of searching for quality businesses run by trustworthy people and that are valued at a reasonable price.
We are grateful and honored to have the founder of Overlook Investments and the author of The Model on the show. Here comes our conversation with Richard Lawrence. So hello, Richard, and welcome to Investing by the Books podcast.
Yes, welcome indeed. It's such an honor for me to be here, and I'm thrilled. Investment books have been one of the great passions of my life. And for the last 30 years, every other book I read is an investment book. And so I really appreciate our common interest. And so I'm delighted to be here with you. Thank you.
Thank you for taking the time. And where are you today?
I'm in my office north of San Francisco, about maybe 10 miles north of the Golden Gate Bridge, which I think most of your listeners will know.
So Richard, can you tell our listeners a bit about you?
So I'm originally from New York, outside New York City. I grew up a sort of traditional middle-income family. My dad was a money manager, what we'd call today a multifamily office he ran with his partner. I went to schools, and I graduated from Brown University in 1978. And it was really towards the end of the inflationary era of the late 60s and 70s. And it has some relevance for today with the inflation going around the world. But at that time, I could get no job in America despite having a degree from Brown. And I went to my professor and he said, "Richard, go to Venezuela." And I kind of looked at him and go, huh? I said, okay. because I had no other plan, and went back to my dorm and called my dad. I said, well, I figured it out. I'm going to Venezuela. Dad went, huh? Because I didn't speak Spanish. But Venezuela was benefiting from the last 15 years of ever higher inflation in the oil boom. And indeed, it was one of the huge boom towns. It was the richest country in Latin America at that time. And so I went to Venezuela. I spent 3 years in South America, came back and worked for a wonderful man named Jonathan Bush, who passed away a little under a year ago, actually on this exact same day that David Swenson, who ran the Yale Investment Office, died. And John hired me to run the research at a small brokerage firm and money management firm in New York. And I did that, and it was just the most amazing experience. John would pull us all into his office on Monday morning and teach us how to invest. And I'd wander around the world looking at companies. And I was completely enamored with that. I was doing the CFA at night. And one day I walked by chance into the Malaysian consulate in New York City, and I picked up a brochure that said that the Malaysian economy had compounded at 6.8% since 1968 without a down year. And I literally turned around. I said, I'm out of here. And I picked up my girlfriend, who's now my wife, and we traveled for a while, but I ended up in 1985, late 85 in Hong Kong. I was broke. I had a backpack and nothing else, no job, no visa. And I started working. I was one of 3 Americans at that time working in the Hong Kong Stock Exchange, which really wasn't the Hong Kong Stock Exchange. It was 4 different exchanges, all interconnected with closed circuit TVs and whiteboards. So it was really, really early days. And I hooked up with a group called First Pacific, which was a conglomerate out of Indonesia. And I went to work for one person, Bob Meyer, who was running one part of that, an investment arm. We bought a listing, kind of like a SPAC deal. We bought a listing on the stock exchange. We had a market cap of $4.5 million US, and we're the 93rd largest public company in Hong Kong. Just to put that in perspective, today the 100th largest public company in Hong Kong would be tens of billions of dollars in size. So, and China had no stock market. Indonesia had no stock market at that time. So it was really early days, and I worked for this arm of First Pacific for about 4 years, and then I went across town to a friend of mine, Dr. Mark Farber, author of the Gloom, Doom, and Boom report. And I said, Mark, I don't want a job, but I want to work in an environment where people are investing as a principal. And he said, well, if I don't have to pay you, fine. I have this library, a little tiny office, which was Mark's library. And I went in there and I spent a year really on my own putting together the core of what is still today our investment philosophy and the makeup of what is Overlook Investments. And 80% of what we are today was put in place in that year. And then 12 months later, I went out and raised $30 million from sort of friends and anybody I could get money out of, mostly individuals. And we started Overlook.
And why did you name it Overlook Investments?
I grew up outside New York on a piece of land that was called Overlook Farm. And it was a farm up on a hill. And in the wintertime in particular, you get a good view. And I had run a kind of a little family partnership with my brothers and my dad. And once I started investing in Hong Kong, and that had done well. So I said, for feng shui reasons, I better not change. So I just adopted that name.
I thought it was Overlooked Investments, like you were the ones that no one has found.
No, a lot of people say, is it overlooked because you've overlooked all the details?
Rather the opposite, I guess.
Yeah.
We will talk more about that.
I think we will start off with discussing the book a bit. You have a whole chapter dedicated to bear markets, which I think is quite fitting as we have one currently, and also, I mean, when you read the book, you really see you have a table there showing how many bear markets you have been through, and it's been quite a lot since the 1990s, I think. What are your main lessons from investing in bear markets?
Wow. Well, bear markets are the essential time, right? This is when, to use an American baseball analogy, you cannot swing and miss. You cannot you cannot misplay the bear market, because a lot of times that's it. You're gone. You never come back. So this is the essential time. And it's interesting that we're in a bear market today, where a lot of these lessons are a little more poignant than they were a year ago when I wrote the chapter about bear markets. But I think there are a few core lessons that you have to learn. The first one would be, don't take money in at the top of the bull market. When everybody wants to give you money, don't take it. Now, that's a very hard thing to say no to. So we've put in place a legal cap that restricts our ability to take the money in at the top. And we can come back and talk about the cap, because I think it's fundamental to really high quality asset management. But if you don't take the money at the top, then as the bear market unfolds, you will have some investors who just get scared or get caught, and they'll redeem, and you replace them with, a backlog of investors that you have built up. And then, so once you've settled the capital, and you now understand that you are not selling the crown jewels to get the money for the redemptions, right? Then what you do is you just execute. And a lot of that is buy early and often, okay? Because you don't know how far it's going to go. You don't know when it's going to end. And so you buy often, and you buy and the stocks go down, you buy and the stocks go down, you buy and the stocks go down. You have to do that, because it's a failed theory that you're going to buy at the bottom. And in my view, much more interesting in my view, it's also a failed theory that you're going to buy on the first leg up, because you've bought and they went down, you bought and they went down, and now they're going up again. You say, nah, not going to catch me. And so you really don't buy there. So it predicates you that you have to buy early and often, number one. Number two, you're going to have to take your portfolio and you have to hook your cart to some horses. Okay, this is not a time to go with a core portfolio of 20 to 22 holdings to 35 holdings. This is when you go from 22 really down to 19. And that concentration is really important, because you need some big, strong horses that are going to get you through. Particularly, what you don't know is how deep the bear market's going to get. So we've seen some really big ones, and I can tell you, when you get into a big bear market, you really need some strong horses at the top of your portfolio to get you through. The other thing is within a team dynamic, you cannot question the investment philosophy. It is, at a time when it's not working, you do not question it. And that's a hard thing to do. A lot of people want to, oh, well, we should do this, or, oh, we got to do that, or, oh, we should have 35 names. Nuh-uh. You have your model and you just execute it. And I think it's also one of these great times where relationships that you build up with your public companies really get deeper and deeper, because they're in many cases as confused as you are. I remember times in 97, 98, I'd go out and see a CEO, and he had as many questions for me as I had for him. Like, what the hell is going on here? Everything's gone to zero. So, and then there are a couple other things that you have to remember. When you're in a bear market, they feel like they're going to go on forever. And in fact, I calculated in the book that the average bear market from the 1920s has been about 16 months. And the average decline has been about 35%. So they end and they don't go to zero. And when you're in them, you feel definitely like they're going to zero. And so that tells you, it should give you the impetus to keep pushing ahead through bear markets. Don't stop. Um, don't stop moving forward. Don't and I guess the other thing which is critical for your team, and this is in all times, but we have a policy where we do not do postmortems on companies, which are really finger pointing exercises. I leave that to Ray Dalio. Ray likes to point fingers at employees who make mistakes. I find it an absolute anathema. We're in this together, and it's only when you acknowledge that you've also made bad stock decisions, that you hold the team together, which is really important. So, I mean, and I can go on, but you get an idea of how important this stuff is. Surviving bear markets is.
Yeah, and in the book you also provide some really nice real-time reports from the time, and especially from the 1997 and 1998 Asian crisis. You write about these 16-hour days, sleepless nights, and this market just keeps on falling, and your title, one of those parts of the book, "Are You Joking?" when it keeps going down. And one of the fascinating examples that stayed with me is this 99.3% crash in the Thai property sub-index. I mean, it's equal to a stock going down 80%, then dropping another 80%, and then falling another 80%. And that's just crazy, but it really stayed with me. How do you find the motivation to continue?
Well, I had 2 young kids and education bills, and Hong Kong's always been a very expensive place. I had an enormously expensive rental, even though it was an old apartment. So I had no other option. This is what I did. So but I think if you ask people around me who have known me for a long time, um, if they ask what the dominant trait of Richard Lawrence is, they probably would say that uh, certainly one of them would be that I'm really competitive, and it takes that competitive drive to get through a really bad bear market.
Because it seems like you're quite spontaneous, going to Venezuela and then heading into the East Asia and traveling around, but you also seem to have such a insane persistence and perseverance. You just keep going. How is that for you?
Well, I mean, I've always kind of felt that no one would ever hire me. I'm probably the only person on earth. I've never gotten a call from a headhunter in my whole career. So I figure there are no other jobs for me out there. I just, but in all seriously, look, I am by profession, I'm a stock picker. This is what I love. I love figuring out companies and what they're worth. I love figuring out management. I love looking at their long-term track record and really digging into how they treat their minority shareholders. I love the challenge of trying to convince executives who come from an entirely different culture to take steps to improve their company, where they have no right. They never listen to some guy with red hair from New York. They just haven't done that. And here he is. He's being very insistent that that we need to think about things and then learn that actually Richard was right. I love the fight. I love the chase. I love the discovery. I mean, it's the best. We're in the single most competitive market in the world. It's like being able to play at the NBA, but you're not playing just against 400 NBA players. You're really competing against almost everybody in the world with even small amounts of money. And I love that the competition. I love the challenge, and we've been incredibly fortunate to kind of figured out our niche in this.
We feel the same way here, and that one of the reasons why we have this podcast and try to read as much as possible, trying to understand and trying to unlock it. Because as I understand from listening to other podcasts and so on, it's not so much for you about, or not at all maybe, for the money, like your own personal money. It's more about delivering to investors. That's or what is your motivation in that sense? It's more the challenge.
Yeah, I mean, to me, it was always the challenge. It was always the challenge. I don't have a very extravagant lifestyle. I live in the same house I've lived in for 22 years. I drive a 13-year-old car. Um, and I think that helps. I have a wife that's a true believer in the danger of climate change. And so she lives an incredibly simple life. I think that keeps me grounded. Um, Money is an enormous corrupter. I actually have fired people because they cared too much about the money. The money is the end result. What the real value is having the opportunity to invest for a living. That's where the value is, and the money comes along. As I tell my kids, the less you care about money, the more you generally will make. And in a world filled with greedy people, that's a good philosophy to have.
Talking about philosophy, the investment philosophy of Overlook, as you've mentioned, has been more or less in place since 1992 and focuses on 4 pillars. First, superior businesses. Second, superior company managers. Thirdly, valuation discipline. And fourth, long-term investment horizon. And you describe each pillar in the book and also bring up examples of companies you have invested in, which makes it, I think, really easy for us readers to grasp what you mean. How is the process like when you decided to focus on investing in quality companies? I think many value investors maybe start out with just trying to buy the cheapest stuff they can find, and then, in the end, end up with quality companies. So can you describe your process there?
Yeah, it's a really interesting comment, Niklas, because for a long time in the early 90s, I thought Buffett had kind of sold out as he had made this pivot over the prior decade. And then I realized that we also made that same pivot. And it's really due to size, I think, more than anything else. When I was managing 30 million or $100 million, just go out and buy the cheapest damn thing you can find. Um, but you learn lessons of that are really important, which is going back to some of the things that are in the investment philosophy. When we talk about superior businesses, it's that really high profitability that is critical to long duration, which was also one of the pillars, right? A lot of times these really, really cheap stocks, these cigar butts on the street corner, they don't have that really high enduring profitability. And as you go along, you realize that's a really high value, that you can buy a stock and you can own it for 3, 5, 7, 10 years or even longer. That is really, really powerful. Where these cigar butts, you got to buy them and then you got to sell them. You got to buy them right and you got to sell them. And then things like bear markets are complete inconveniences to that process. So I think that I'm probably, Buffett did it. And I think a lot of us after him have gone through that same kind of transition.
And which other investors have influenced you the most in coming up with the principles? You mentioned Buffett, but other?
Well, I have this love-hate with Buffett. The stuff I love most of Buffett are the things that he wrote in the 60s before he'd set up Berkshire Hathaway, those early partnership letters. I thought those were just fantastic. His letters in the, really up through the 90s were really, really good letters. But then he got into owning companies and became less interested in the stock investing and talking about that. So it's been kind of a love-hate deal with him. But I've been touched, and I think I was thinking about it last night in advance of this conversation. What I was fortunate to do, largely through reading books, meeting people, listening to people, however I interacted with them, is I didn't take everything, but I took slivers. There's a great investor, John Neff. Well, John Neff told me about an equation and how he was looking at the construction of his portfolio. Boom. I don't know what he wrote about in his other 290 pages, but those 2 or 3 pages I really got. And then Charlie Ellis taught me about rebalancing, which had been just a blind spot for me. My dad, John Bush, Peter Cannell, these were the old prior generation, these lions of the original fund management generation, I had access to a lot of them, and they taught me a lot. Mark Farber, who has been a dear friend for 38 years and been on my advisory board for 30 years, and I'm probably the single person on earth who's read more of Mark's newsletters than anybody else. But Mark has this wonderful ability to say, it's what's on the backside of the coin is what's important. We all can see what everyone's talking about, but this to bring a contrarian, not stupidly contrarian, and being a contrarian, is you got to go through a learning process on that. But he was, Mark's definitely on the list. I think for your readers, John Train, he wrote a whole series of books called The Money Masters, which were little chapters on various great investors. And in 12 chapters, I got two cousins. I would routinely get two cousins out of John's books, and and so slowly I found myself in the early days at Overlook, and even as I go on, I'm slowly accumulating my cousins who have contributed something to Overlook. There are very few components of Overlook that someone didn't do before, but we've got to bring them together in an authentic way. So there are lots of other names. Leon Levy. I don't know. Your readers probably don't know Leon. He was one of the first hedge fund managers in New York, ran a hedge fund called Odyssey Partners. And I was introduced to Leon by Mark Farber. And he had an office filled with Greek statues and frescoes. And he had a pipe. And he was always covered with ash. And he's all sitting behind there as kind of this professorial guy. And I'd go in and see him. He was an investor, so I go see him. And it was during 97, 98. And I was just crucifying people. And Leon looked at me and said, well, Richard, you don't know how to sell securities. And I literally, my mouth open, my jaw dropped, and I had nothing to say because he completely denuded me in his office. And I remember I went back out onto 53rd, 54th Street in New York, and I actually leaned up against the building, kind of hyperventilating. And I realized that I had to learn how to sell securities, and so, it's those experiences or those chapters in books, which is why I love your podcast, because you can bring those sort of opportunities to all your listeners.
It's really impressive how you can have such an open mind to take in all of these different perspectives and opinions, because it's easy to, in that situation, maybe feel threatened and say, no, I'm not going to listen to you, and reject it.
Yeah. Well, I'm a humble guy that's very well aware of my own inadequacies. I need, Eddie, I need all the help I can get. So, but it's been a rich process. There was one, and I tried to look it up yesterday on the internet, and you can't really find it. But in the 90s and 2000s, there was a guy in New York who wrote a newsletter called Outstanding Investors Digest. And it was so infuriating because he'd send out 3 issues a year, but there'd be like 6 months, nothing, and then 2 would come in 2 months, and then nothing. And I'd always have to write him, well, did you not send it to me, from Hong Kong? But what they were interviews that he had with money managers, where these money managers got into such incredible detail on their companies. They were so encyclopedic in the knowledge of their companies. And that was like, I got to be that guy. I got to have that level of knowledge about our companies, because that's where your advantage is. So that was another media that just was so helpful to me.
So when trying to find the best investments, one of the pillars that we mentioned here is finding the superior company managers. So we're a bit curious if there are any characteristics of managers in Asia that you think are more important and that Western leaders should embrace.
Yeah, I think that as a general rule, I think Asian entrepreneurs are incredibly instinctive, really intelligent. They're tactical, but also strategic. They really think long term. They're tough. And so as a group, I really like the Chinese entrepreneur writ large all across Asia. I've had incredible experiences with them. Now, within that group, you have a spectrum. And on some of these guys on the spectrum are way too aggressive, right? Like the real estate developers in China, and real estate developers in most places, way too aggressive, right? And you had the other ones way too conservative, or guys who are just stealing from minority shareholders, way too aggressive on minority shareholders. And there are others that are in just that sweet spot, trying to grow their business 11, 12% per year, paying dividends, got high profitability. Those guys got good corporate governance because they don't need to rip you off. And so it's really, how do you find those people? Okay, well, number one, look at their long-term track record. How did they behave in 97, 98? How did they behave in 07, 08? If they did a deep discount rights issue, or if they had to get bailed out, they're going to make the same mistake again. Okay, so you can really learn from their long-term track record. Long-term track record tells you a lot about the person running the business. When I finally meet these people, I kind of already know them, because I see him in his track record, or her in the track record. But it is tricky. It's an art. You don't bat 1,000. And part of the problem is that you got to start at the IR level. Then you got to go to the CFO level. Then you got to go to the CEO level. And then you got to go to the chairman, who used to be the CEO and is really the guy owning all the stock. And that can take you a year and a half. And by that point, if you made a mistake, he's already stealing money from you, right? So I don't have, and I have never complained about this, these CEOs are not university colleagues of mine. I did not go to university in Asia. I don't have family members that run public companies. So I had to, I'm pretty well versed on starting at IR, going all the way up to the top. And that's part of just, our blocking and tackling. But I think if you can get the other things, the superior business, if you can get a chance to really buy it at the right price, and see no really obvious red flags in the track record, you're onto something. And you really got to meet the guy to confirm. And then look at how does he talk to you? Like a lot of guys talk to you like you're a dollar bill. Well, I'm a dollar. If I'm just a dollar bill, he's probably wants my dollar. You know what I mean? And so, will he really engage? And that's why, to a certain extent, we've always liked our form of activism, because we're touching on things that are really important to us. And will he engage with us? Will he think about it? Will he come back with questions on it? Or is it completely dismissed out of hand? Because, as I said earlier, I'm a redheaded guy from New York, and so that also gets you a little insight into these executives.
I think what you say is quite similar. We had Rajiv Agrawal in the podcast a couple of episodes ago, and he focuses on investing in India. And he says that the one thing he really doesn't agree with Buffett on is, at least in India, is that the business is more important than the management. He thinks the management is really key figuring out businesses in India. And I think listening to you, it seems the same. But how would you say? I don't want to put the words in your mouth. So.
I mean, Niklas, I think the businessman made the business. Okay, so yes, we need the business, and then we need to reflect also that guy had a big part of it. Yeah, sure, he got lucky in some cases and whatnot, but usually you build a big business that's super profitable. You did some things really correctly. So I think they're a little bit joined at the hip. And when you look at our investment philosophy, superior businesses, that's the profitability of the business. That's the cash flow. Management with integrity and know-how to run a public company. That's the management. disciplined valuation. That's the valuation you pay, because you can get the best management and the best company, you pay the wrong price, end of story. And then long duration, because the more long duration stocks you can get into, the easier your life is. That coming together is what the secret sauce is.
And two obvious challenges that I think of when investing in foreign markets must be language and culture. So I'm curious, how did you overcome those? Or how do you deal with them?
I think I said I was competitive before. Maybe I need to say that I'm probably pig-headed a little bit. To me, it just made the puzzle more interesting. And as I got going and I got a little bit better at it, because I was seeing 200 and 250 companies a year when we were really starting out in the early days, then I figured out that a lot of these guys were my age or a little bit older than me, and we'd come through similar things. Once we survived 97, 98, I'd sit down with executives like, how did you enjoy 97, 98? And we, the bond was just brilliant. So I think the way to break down bonds between cultures is being completely honest and authentic with people and show that you care. And indeed, if you've grown a big business in Asia, I have an absolute mountain of respect for these people, because none of this stuff is easy. Nothing in life really is easy, but building a big business. And so the fact that we can be very respectful and towards their achievements is a very honest and authentic attitude that we have.
And you have a whole chapter dedicated to China in the book. So can you tell us a little bit about China and the evolvement since 1985 to today from an investor perspective?
Well, I actually broke it down into 3 chapters, but kind of one section, because let me say at the beginning, there's never one China. China is just this enormous, diverse place of so many different things, right? So for Richard to put it into 3 categorizations in 3 chapters was an enormous oversimplification, but I tried to capture, the early days when basically they were learning how to manufacture for export, and then the second stage where they were beginning to have public companies, and and there were all different ways that we were trying to get exposure into China's growth, and the last stage where really the Chinese public companies came of age, going in the early part of that chapter where really the CEOs had no role models. And by the end of the chapter, we're seeing not only role models, but we're seeing really great companies that were big, and this is something that's happened over the last 9-10 years. Is all of a sudden we looked up, and instead of having 500 beer companies spread out all over China, we now had 7 and was going to 3. And every business had consolidated. And all of a sudden, these businesses now big. So China's beer company, largest beer company, will be one of the biggest beer companies in the world. Same with the noodles, same with the milk, same with, the utility companies. All these things, we coined it, when you're big in China, you're big in the world. And exceptionally competitive. Not always well run. Sometimes, again, too aggressively, sometimes too passively, right? But they were ambitious. You'd go into them and you would think you were going into a couple $100 million Hong Kong company back in the old days because it was so raw. And you look and you think, oh, this is a $20 billion US company. And it just didn't feel like a $20 billion company, So this enormous evolution from complete fragmentation, all driven by entrepreneurial energy of Chinese people, backed up by some support from the government, but certainly a willingness on the part of the government to help accelerate or maintain the fast growth in China. I think the government alone would not have pulled off what China pulled off. The entrepreneurs probably on their own would have self-destructed. But the combination became incredibly powerful and successful, and you see the results today.
Yeah, it's a fantastic success story. And I just wanted to ask you, when having you here, what we read in Western media now seems to be focused on that the government is becoming more and more anti-business. But at the same time, from reading your book, it seems like a lot has happened in the other direction in the last decade or two. What's your take on this?
Yeah, I guess, this is something you can talk about for a couple of hours, right? There's a lot to unpack in the West's relationship with China today. But I think at a very simple way, that what we can see is life is like across a spectrum. And on the one end of the spectrum is what we call technocratic China, which was this partnership of businessmen and the government that was helping build the roads, build the infrastructure, build the trains, build the ports that all these entrepreneurs could take advantage of. And at the other end of the spectrum is political China. And we've seen periods of great leap forward, cultural revolution, and more recently, where the political China has dominated the technocratic China. And we hit an apex on political China, in my view, about a year ago, where Xi Jinping was just waking up in the morning and outlawing after school education or outlawing cosmetics for women. And, it's all this sort of crazy micromanagement of a society of 1.4 billion people. And I think that is way, way slowed down. I think COVID has presented almost a existential threat for the Communist Party, which, when combined with other challenges they have, like the Ukraine invasion by Russia, like slower GDP, like the decline in the stock market, where Chinese stocks are now down over 50%, like the decline in the real estate market, which is hitting the Chinese pocketbook, slower GDP growth, less productivity of incremental bank loan growth, demographics. All those things are all hitting at a similar time, and it's pulling political China back. I don't think we're in the center where we should be, but we are, I think, headed to more realistic space. What remains is this enormous challenge. And nationalism is a convenient political philosophy, and it can be very, very dangerous. And there's an awful lot of nationalism on both sides with regard to China and the US. And what we need private and confidential discussions amongst the highest levels of the US and China government to begin to put together a new roadmap for a US China West relationship with China.
And what do you think that will happen, or is it your hope?
I certainly hope for the prosperity of so many people around the world. Globalization went on over the last 40 years with the opening up of China, and it drove inflation down, interest rates down, and look how many people got pulled up out of poverty around the world, not only in Sweden, but we pulled 700 million people up out of poverty in China. That's been a good thing. The world should congratulate itself for having done that. Now it all seems we went too far on globalization. Supply chains got extended. Technologies weren't respected. Intellectual properties weren't respected, and so we've got to swing that back and get it more in balance. But there are two ways you can do it. You can have what we're going through now is a managed decoupling. So every businessman, every government official has to look and say, is that business okay to have a global supply chain, or do we need this domestically? Okay. And that's kind of what we're doing. And I think that process goes on, and the longer it goes on, the better it is. The alternative is what we call mandated decoupling or sanctions, where this stuff is going to be told happens overnight. And it could be in response to selling arms to Russia, or it could be in response to China attacking Taiwan, or it could be something that the U.S. does that triggers the response from China. And we need to have really cool minds and experienced hands at this, and to avoid this. And so I'm deeply worried, because when you go to complete mandated decoupling, onshoring back to everywhere. So Sweden's going to make all your products that you think are strategic for Sweden. That is incredibly inflationary. And we're already now seeing the dangers of inflation and inflation expectations. So it's going to be more inflationary for the world, less prosperity around the world, less growth around the world, all driven in the idea of nationalism when we live on a planet that is under attack from climate change and other issues. So there are reasons why it shouldn't happen, and if we can keep the process under control, it'd be good. But political leadership is very weak on both sides, and they are weak, even though they like to present themselves as super strong. They're incredibly weak because they don't have the confidence to really engage for a new roadmap for the world.
Yeah, let's cross our fingers that will improve in the coming years. And coming from a really general question to now a quite specific one, many of our listeners are value investors, and I think many of them see value in Chinese equities today. And I think most of the Western investors focus on the big names such as Tencent and Alibaba and so on. And what's your view on the internet sector in China?
Well, the internet sector has one big problem, which is really supply and demand for their stock. If you go back now 15 months, at the peak of the Asia ex Japan index in February 2021, there was literally no one left to buy those stocks. And so nothing wrong with them. They'll be around in a long time. But boy, they got a lot of people are going to sell that stock to get liquidity, to get their China exposure down, to get whatever, just stocks that go down that much become gum on your shoe, and you got to get rid of them. And so I think we're down a long way in those stocks. So a lot of that has happened. But and also the pendulum between technocratic and political China did not favor these internet companies. So I think the big ones be around for a long, long time because they got very big cash flow positive companies. I think there are companies in China that are quote unquote in the internet space that just have money losing models, and we don't have interest in companies that just chronically lose money. It's not our shtick. We got to leave that to somebody else.
But a great business that you have dedicated a whole chapter to in the book is TSMC, or Taiwan Semiconductor Manufacturing Company. And having lived 1 year in Taiwan myself, I have to ask you a little bit why you love this company.
Well, they just had a better model. If you had walked in 21 years ago with me into TSMC, they would have said several things to you. They'd have said, we don't compete with our customers. We don't compete with our customers. Samsung cannot say that. Intel cannot say that. So if you got a rocket science IC design for a chip, I think you'd rather probably go to Taiwan and have that made to protect your intellectual property. They then figured out that the price of fabs, these huge facilities, were going from hundreds of millions of dollars to now $22 billion to build one of these things. And no product was big enough to fully load that factory. And so you needed 3, 4, 5 customers. And so they spread the CapEx over 3 or 4 customers. And the guy who had to build this plant just on his own, he couldn't get the utilization up above 50%, and he couldn't make money off of it. So that was incredibly important. The other thing is they have been absolutely relentless in in investing in their intellectual property library and keeping that and making it open sourced to their customers. So you can come with your design, but you're going to be missing 4 or 5 fundamental components that you need to incorporate into your design in order to get that chip manufactured. And so their IP library allows you to accelerate that process. And Samsung and Intel don't really do that to anything close to the same degree. And so what we've seen as a result is we've seen TSMC over 21 years pass other semiconductors in terms of technological sophistication. And we've never seen anybody else pass anybody in this. There's never been another semiconductor that leapfrogged someone who got ahead of them on the technological node. The only one we've seen in the last 21 years has been TSMC. And that's the result of a very simple model. Don't compete with your customers. Treat the small guys and the big guys the same, you know? And that was brilliance by Morris Chang, and brilliance in a very simplistic way. And everybody else in the industry was too greedy. They couldn't not compete with their customers. You know, they didn't want to spend the money for the R&D. And you see TSMC, which is one of the most sophisticated companies in the world. We've watched it go from a tiny company to now one of the top 10 public companies in the world. I mean, just crazy.
That's fantastic. And you're still a shareholder after more than 20 years, right?
Yeah, we're still a shareholder.
So going from buy and hold to the art of selling, which you have dedicated a chapter on, which is written by your colleague James Squire. Can you please expand a bit on this?
Yeah, so after my experience with Leon Levy, I spent a good number of years figuring it out. That was when I came across rebalancing with Charlie Ellis in Winning the Loser's War. I remembered a story. There's a story. I was an analyst in New York, and there was a company called Tandon Corp, which made the first floppy disk drive for the IBM PC, which is the first portable personal computer. And the stock was great. Went from like 2.5 up to 35. And John Bush walked into the office one afternoon and sold every client out. And I thought, John, why'd you do that? It's been great. You know, everything's good. It's kind of, and so I wrote next quarter at 32 that it was still a buy. Then the next couple of quarters, it was still a buy at 24, and then at 18, and then at 12, and then at 6. And finally, at 4, I made this ridiculous comment that you've seen me be early on my purchases before, but now is the time, you know, and eventually went to 0. And that day that John walked in, the comment that I didn't listen to is he said, well, we're just getting tomorrow's price today. And you get tomorrow's price today at certain times. Rebalancing is great. The key, and we have defined 6 ways that we sell securities that are in the chapter, because this is harder. It's harder than buying, right? And so what we like to do is when we say, we got to sell this, well, which of the 6 are the reasons why we're selling it? I get it. You know, and so then we can really define, is it tomorrow's price today, or is the industry fundamentally changing, or have they done something? You know, you can break it down, and it's a much more rational discussion at that time. But what James, and this, in my view, this is by far the most valuable chapter in the book. It's the best chapter in a book that I've ever read on selling. And what we've done, and I did some of this, but James really gets the credit because he verbalized it. What we had done was we had tiered our companies. Tier 1 being really these great companies like TSMC. Tier 3 businesses being cigar butts on the street, right, that you try to avoid. And if you look at it, whatever tier you're in depends on the duration that you can hold this stock. Those tier 3 businesses, if you're in it, you better have a plan to get out of it because time works against you. Whereas the tier 1 businesses, time works for you. And that distinction of tying quality of the business to the duration of the holding period. That is an incredibly simple concept. I don't know why it took me, it didn't take us 30 years. We knew this 10 years ago, probably, maybe even a little longer. But for a lot of my life, probably half my investment life, I really didn't. I knew it at some level, but I didn't really have it. Now we really have it, and it's an incredibly valuable concept. And I was lucky to have survived my first half of my career to get to the second half.
Yeah, we strongly recommend everyone to buy the book to get the details.
Yeah, that chapter is worth it all, and you get a lot of extra as well. And I think what we would speak about next is something we mentioned before, the cap on subscriptions. Something you mentioned has been really central to your outperformance, and especially how much the investors in your fund have gained. Because I mean, the fund can have a return, and that's not for sure that the investors will have the same return. I think Peter Lynch example is quite central there, that he delivered this amazing track record, but the investors in the fund at average didn't fare well. So can you maybe describe a bit why this has been beneficial for you and the investors?
So the essential problem is what we see unfolding today at Tiger Global, where Chase Coleman has blown up more money than he ever made over the prior 20 years or whatever he ran. Tom Steyer did this at Farallon, Peter Lynch, the Wall Street Journal's fund manager of the decade during the 2000s, compounded at 29%, and his investors on a capital weighted return basis lost money. This is a chronic problem throughout the whole industry. Time-weighted returns, just get the definitions right. Time-weighted return measures the NAV per share over a period of time, hopefully inception to today. Some people cherry pick, but that's another issue. Capital-weighted returns measure the IRR, or measure the return of individual investors and the investor group as a whole since they were investors. And those two numbers diverge. Ilya Dikhev of Emory University in Atlanta documented about 10, 15 years ago that there was a 7.5% discount between the time-weighted returns and the capital-weighted returns. So if you said your hedge fund was going to earn 10%, the investors were earning 2.5%. And he had studied the top 100 successful hedge funds. So this is a huge problem. Huge problem where investors aren't getting what they want. And what's the result of this? Well, now we have indexing and ETFs. It's a natural outcome that not only could the stock pickers not beat the index, but the investors with the stock pickers were underperforming. And so I got extremely lucky on the spur of a moment. Probably the only thing I can really claim that I invented, because I'd never seen it before. I was sitting at the University Club in New York with a man called Crosby Smith, who was running money for the Dillon family. And I was pitching him. I had no clients at this point. I was trying to raise $30 million. And I'm making my pitch, and Crosby leans back and says, "Richard, why aren't you going to be like everybody else? Just go out there and market all the time." I said, "Well, Crosby, what I want to do is I want to invest, And he kind of gave me a smirk. And I said right there, "Well, Crosby, how about if I legally cap the fund, subscriptions into the fund, at $30 million? He said, "You do that legally and you have your first investor." And he put out his hand. And I thought, okay, that wasn't a big deal because that's what I want to do. I just wanted to invest for a living. And then a couple of weeks later, I walked into my dad's office and the secretary handed me a note. And some guy I'd never heard of called from Switzerland saying that he had heard I was setting up a fund and it was capped and he wanted me to reserve space for him in the fund. And I go, "Oh, well, that's the damnedest note I ever got, And because it created scarcity at some level. And so I got into the cap, and then I realized that I saw my friends at the tops of bull markets. In the old days, they used to say, "I just got $10 million in over the fax machine. I don't know what to do with it," And we didn't have any of that because we never had those flows in. And then we evolved the cap to allow us to grow, but grow at a modest rate that did not separate the time and capital weighted returns. And so for Overlook, and it's in the book, the time and capital weighted returns are almost identical over 1, 3, 5, 10, 15, 20, 25, and 30 years. And you don't see that very often. And the reason you don't see it very often is greed. Greed on the part of the fund managers and greed on the part of the investors. And it's absolutely fundamental to what we do. In addition, in the last 3 years, we've returned $1 billion twice to slow the growth of assets under management because we didn't want to be. I don't want to be that big, And again, money managers don't usually do that. I mean, Chase Coleman's doing it now, but those are called redemptions and side pockets and stuff like that, right? But the cap, if you're a young fund manager, you've got to seriously think about how to structure your fund with a cap on subscription. It brings you the best investors. It brings you the longest term investors. The highest quality investors, and it brings you stability of your assets through bull markets and bear markets.
It's so generous that you're sharing all your knowledge in the book and also in this podcast. What is the reason why you wrote the book?
Well, it's been very simple, Eddie. I was one of the first individuals to set up a fund management business in Hong Kong 30 years ago. And over the years, many other young fund managers came along and they said, hey, can you make some introductions for me? And I said, sure, I can do that. But I got just one small thing. I want to see your legal documents. And I want them to have a legal cap on subscriptions. And if you put the legal cap on subscriptions in your document, I'll introduce you to investors. No one ever came back to see me. So you can draw your own conclusions.
Yeah, that's what I was thinking. So then you also have this Columbo question in the book. And so I have to ask just one more thing. Do you think Overlook can keep returning about 15% per year over the next 30 years?
No, I would have said we could have done it for 5 years, let alone 10, 20, 30. If I was sitting with my dad 30 years ago in his office and said, yeah, Dad, we'll do close to 14.5, 15% for 30 years. Get out of here, So, but coincidentally, we did almost the exact same number in the first 15 years as the second 15 years. And that's hard to do also. But I think just dedication to the model, do one thing, do it well, have passion and dedication, don't be greedy. Those things are really helpful. We never promise any number. I think the inflation, the world backdrop, deglobalization, all those things are huge threats to global prosperity. So,
do you think you would have performed better or worse if you had focused on investing in the US over this time?
No, I think being in Asia, being that sort of complete outsider suited me. I think it suited me really well. I don't think we'd have done as well.
You would have done well, definitely anyway, I think, but...
You got to get lucky. We met some great managers, and I guess we would have met some great people here too.
Yeah, you have this Hall of Fame. We haven't mentioned it so far. It's quite interesting in the book. You mention all these managers and people who are there. How did you come up with that idea from the beginning?
Well, I'm a big baseball fan. I love the statistics of baseball. If you know baseball, it's really all about numbers. I used to be able to, I would always calculate baseball batting averages and ERAs when I was younger, playing a board game with my brothers and cousins. And baseball is the quintessential statistic sport. And of course, baseball has in Cooperstown, New York, the Hall of Fame. A lot of things have Hall of Fames now. All the sports have Halls of Fame. There must be Halls of Fame in Sweden, but the main one, the original one, was Cooperstown, New York for baseball. And some of my favorite baseball players are in the Hall of Fame. And so that was where I came up with the idea.
And how many superior managers are in the Hall of Fame now, in the Overlook Hall of Fame?
There must be about 22, 23, 24, somewhere in there. We it's a good list over time, and in fact, as you look down the list, almost all of those guys reacted to something we recommended. And going way back to Morris Chang, where I called out Morris Chang on some policies that TSMC had, and I wrote him a letter and basically called him out on it. And he called me at home personally. And that kind of leadership is really what we look for. And a lot of the people in the Hall of Fame list also took on similar actions. That took a great company and made it, you triple the duration. When they say, "Yeah, we're going to do that, Richard. You're right. Actually, I apologize. We haven't gotten to it."
It's been really fascinating to listen to your story. And before we end, we always speak about books because that's what we love. And in the introduction, you write that you love few things in life as much as a great investment book. So besides the model, can you name a few books that you think every serious investor should read?
Well, I mentioned a couple. Outstanding Investors Digest. It's hard to find. I couldn't do it. John Train's books on um, on New Money Masters. I started out with Peter Lynch. One Up on Wall Street. Peter was just telling stories, and in our quarterly reports, we just try to tell stories of our companies to communicate. I thought so. I learned how to tell story from Peter. Um, the CFA Institute put out a series of anthologies, classics, which were classic news or newsletters that people had written, and they got all the best over the last 100 years, and they put them all together in an anthology that was edited by Charlie Ellis. Those books are just fantastic because, again, you can like 2 words into it, you realize he's not your cousin, right? But others, so I mentioned John Neff, who I learned a lot about portfolio construction from. Of course, I'd be remiss if you didn't put really near the top my really respected friend David Swenson's book, Pioneering Portfolio Management. Um, I remember sitting in bed one morning in Boston at a house of a friend of mine, and I was reading the book, and I read a paragraph in it, and to my wife, and my wife said, "Shit, he plagiarized that from you, Richard." Now, of course, David Swenson did not need to plagiarize Richard Lawrence, but we overlapped on so much, and that's a great book. Margin of Safety is a great book. I had for years and years and years. I had the Xerox copy, but when I wrote my own book, I bought a copy. And then you find books that are out there that are come out of nowhere. And I got one here called The Investor's Equation by a guy by the name of Frank Ganuscio or something. Ganuscio, William Bowen and Ganuscio. It's called The Investor's Equation, Creating Wealth Through Undervalued Stocks. And this guy really highlighted return on equity and all that comes with it. And, and the guy's completely unknown and, not a famous book, but it's just you just never know when you're reading investment books where you find that piece of gold. And then, of course, my great friend who's passed away, but the Mind of Wall Street by Leon Levy. Those are a few that'll keep your listeners busy for at least a few months.
Yeah, that will take a time, and I just want to mention that about David Swenson. I think you have a fantastic story about David Swenson coming to Hong Kong to, and you think he's gonna take money out of your fund, but he does the opposite. Maybe you can tell that story. I spoiled it a bit now, but
well, but you have to put it into context that this was May of '98. We were 3 months off the low. September, October, November, December, January. No, from August to January, I'd been down 10% a month every month or more. And the interest rates in Indonesia went to 99%. It wasn't enough to hold the currency, and they couldn't go higher because the accounting systems couldn't do triple-digit interest rates. I mean, the absurdity of it, the absurdity of 97, 98. You mentioned about the Thai property index. That was actually an aggregate index. It wasn't one stock. It was the whole property sector went down 80% 3 times in a row. I mean, it just got absurd, right? And so Swenson shows up. I'm pissed off because he can only meet me on a Saturday in June in Hong Kong, and it's hotter than Hades. So I have to pay to turn on the aircon. And I didn't even have a presentation. I looked for it the other day. I didn't have a presentation. I was just talking. And I went through for about 20 minutes everything that I was confronting. And David turned to his sidekick, Mr. Takahashi, and said, have you heard enough? And he said, yeah, I have heard enough. And David turns back to me, and before he can open his mouth, I put my finger out and I said, David, I'm not finished. And I went on for another 10 or 15-minute rant about everything I was dealing with. And then he says, okay, Richard, we'd like to add money. And by the time we got things organized, it was September. We were 2 months off the bottom. And it was one of the great investments, one of the really courageous things I had ever seen. Surprised the hell out of me.
And if they would have taken money out, I mean, you wrote in the book that you would have been
that probably
had
would
to close
been
down. Yeah.
Fantastic story.
So thank you so much for taking the time, Richard, to come on the podcast and share all your thoughts on how to become a better investor and also person. Do you have something more you want to finish up with?
No, I think I think that managers, sometimes we all strive to be so good that we focus on performance, short-term performance, and everything else. And what you have to realize is the reward is the trip. Getting to do, as my dad used to say, I get to go into the office and learn something new every day. You can't do that in many industries, so we should all consider ourselves incredibly fortunate and make sure that all of us are enjoying the journey as well as the result.
And for listeners who are interested in investing in Overlook or following your performance, is that possible?
Yeah, they can write us in there's email rlawrence@themodel, which is the name of the book.com. rlawrence@themodel.com. And you can write me and now I can connect people.
Perfect. We'll put that in the show notes.
Yeah, good.
Perfect. Thank you so much, Richard.
No, thank you guys. Enjoyed it. Appreciate your time.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.